Alrighty, next thing up here. How do you avoid a dead money stock like Salesforce has been, right? Salesforce 5-year return, negative 10%. Dead money, technically losing money, right? How do you avoid stocks like that? I'm going to give you 3 of the biggest pitfalls to avoid when it comes to these sorts of stocks, okay? First one, listen close to this segment. Dropping gems here, okay? Paying sky-high valuations. You want to pay sky-high valuations. In the short term, it could actually pay off. I've seen a lot of stocks that are just at ridiculous valuations go up to even more ridiculous valuations. And you look at the forward P and you're like, dude, there's no way people are going to make money over the stock over the next 10 years. Like, there's no way. But that has no ramifications on the next 10 months or the next 10 weeks. So over the next 10 weeks and the next 10 months, that stock could go up even higher and higher and higher. And yeah, maybe that stock doesn't make people any money over the next 10 years, but it could make people money over the next 10 weeks or 10 months. Right? But if you pay a sky-high valuation, you're setting yourself up for dead money as an investor potentially over a 5-10-year span. And you look back and you're like, I've lost money on the stock, or I've hardly made any money and I've been in it 5 years? What? Like a CRM situation, right? So a good example of this, I want to give you guys some real-life examples here. Palantir. Palantir, I wouldn't touch the stock with a 10-foot pole at these prices. With that being said, Palantir could go to 200 in the short term. I have no clue where Palantir is going to go over the next 3 to 9 months. I could go 200, could go 250, could go 300, right? Or maybe it tops at 175. I don't know. But I would not touch it with a 10-foot pole at these prices, right? Which is why I've sold the far majority of my shares. I only hold 1,000 shares. And that 1,000 shares is just in case I'm wrong on Palantir and maybe they grow at like a 50% plus, revenue number for like the next 5-10 years. Because if they grow at a faster than a 50% revenue clip for at least the next 5-10 years, then you could make an argument that Palantir could still actually be a moneymaker here at these prices, right? I have a lot of doubts about Palantir growing at a 50% plus revenue clip for the next 5 to 10 years straight. I have a lot of questions about that. I don't think that's super realistic. Although, still being a shareholder of 1,000 shares in the public account, still owning a little bit in other portfolios, I wouldn't mind that, but I wouldn't touch it with a 10-foot pole. Here's a deal with Palantir, right? 295 forward P, a 202-year forward P, right? I mean, this stock is setting up for a horrible 2026 to 2030. But once again, over the next 3 to 9 months, it's anybody's best guess what happens with Palantir. But I'm just telling you, when you got a forward P and you're already, Palantir's already been a profitable company for a bit now. When you got a forward P at 295 and a 2-year forward P at 200, right? Remember, 2-year forward P, a lot of stocks are under 20, usually in the market. So you're over 10x. I think the stock's setting up for a horrible 2026 to 2030. I think the stock's either going to be flat, from basically the high it hits this year in 25 to, let's say, in 2030. I think the stock will either be flat or have lost people money. And so we'll see what happens, but you got to understand, when you pay a sky-high valuation, man, you're setting yourself up for problems. And I've seen it continuously in the market over time. People will pay crazy prices for stocks, and then over a 5-10 year span, they have nothing to show for it. Nothing. But in the short term, who knows? Number 2 of these things is focusing on the hope rather than financials. This is an issue I see continuously in the market. People hope a company's going to do blah, blah, blah. They're not looking at the financial statements. They're not really looking at the income statement, the balance sheet, the cash flows. There's, there's some bullish narrative around that stock, and they're like looking at that and they're like, this is like the next big thing because of blah, 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 right? When the financials are showing you the company's actually in a lot of trouble, right? A good example of this, and if you follow me on X, I get them going, man. I get them going. Look at this post. I just did it 5 hours ago. It already has 233,000 impressions on X, man. We get some views on there, right? And by the way, if you ever want to follow me on X, I always have it linked in the description area of all my videos. But I put this out. I said, I can't believe people are really buying Tesla stock in 2025. This is a year to sell Tesla and get out, not the year to buy. You have to learn the hard way. Oh, well. And, Tesla's financials are for the dumpster. We all know that, right? Like, it's bad. But there's a lot of hope around Tesla, right? The robots, right? Which, once again, that's not mattering anytime soon. The robo-taxi, which, someday could be a big business for Tesla, but it's not anytime soon. The car business is a disaster. The energy business growth rates have been going down substantially. Like, it's just, it's not a good situation, but the stock is hyped right now. It's got the hype behind it. And so it's moving up, but, I think that setup is not a good setup. Not a good setup at all. So the moral of the story is, the same thing has happened with Tesla in the past. If you look at the stock, where it topped at back in 2021, I mean, it was right around the price it is now. And that was back in 2021. And that was in another hype cycle. But that hype cycle was different. That hype cycle was around EVs and how Tesla was going to be dominating in EVs, right? And around the dojo and all that sort of stuff, right? And dojo, I don't even think they're doing that anymore at this point in time. And we know EV sales for Tesla have collapsed. So these narratives come with Tesla, and it's like, oh, everybody's going to do this. Oh, they're going to be selling a trillion, billion, billion robots. And it doesn't happen. And people are like, oh, and then the stock gets absolutely obliterated. And then, it goes through another hype cycle. So do understand that in regards to Tesla, it's, an ugly situation there, okay? Number 3 is buying a business in decline. You buy a business where the revenues are going down and they continue to go down. Doesn't matter what forward P you paid for that. You could pay a trailing 12-month P of 6 on it. If the business is in decline, no one's going to want to buy that company. No one's going to want to buy that stock. They're going to look at it and be like, I'm good. Thank you very much. Like, I don't care if it trades at a forward P of 5. Doesn't matter. It could trade at a forward P of 3. And people are like, if the business is in decline, they don't want to own it at basically any price. All right, 3 might be a little bit excessive, but you get the picture here. If people feel like those revenues of that company and the profitability is just going to keep going down in future years, it doesn't matter the price. They're not going to buy it. They're not interested. And so you buy a business in decline, you can set yourself up for dead money in a stock for years and years to go in the future, okay?
Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you looking at in front of you right there? That's the 6-figure Hall of Fame. Do you want to see the next one? That's the 7-figure Hall of Fame. Now, that is my private group. Those are members of my private group that have scaled to 6 figures, multi-6 figures, 7 figures, multi-7 figures in their stock market portfolio. They say you are the average of the 5 people you associate with. If you're somebody that is having trouble finding other long-term investors that are focused on building their wealth over the coming years, finding like-minded folks, look no further than my private group. We got a tremendous amount of people. We're consistently talking with each other, learning from each other, researching companies together, sharing news about our different companies, right? We do all that inside my private group. If you would like to apply to join us in there, go down in the description area. There'll be an application down there. You can click on that and you can apply to join us in there and take your game up to a much higher level and associate with the type of folks that you actually want to associate with.
Alrighty, guys. So let's talk about this stock that is dead money for me. What stock is it? It is PayPal. PayPal. PYPL. I've made a whopping 11% on this stock, $13,000, right? Now, if this was a relatively new investment, great. That's a great start, right? But the fact is, I started buying the stock, we can say 2 years and 4 months ago in the public count, right? So almost 2.5 years ago, started the position. And I don't have a lot to show for it, just to be quite frank, right? I mean, think about the stock market itself is up dramatically more than 11% since that time, right? And that doesn't matter if you look at the S&P 500, if you look at the Qs, heck, even the Russell 2000 is likely up way more than that. So the Dow Jones Industrial Average, doesn't matter what index you look at, it's up way more than that. You can even look at inflation. If you factor in how much inflation's gone up roughly the past 2.5 years, you could say this is arguably lost to inflation, right? So PayPal has just been a dead money stock. It's exactly what we spoke about last night in the video, right? So what's going on here? Why is this stock dead money? Do I need to get rid of this stock? Well, here's the deal, okay? This was PayPal's latest quarterly report. PayPal described it as strong. PayPal had a strong second quarter, right? So what does a strong second quarter mean for revenue? Net revenues increased 5%. 5% is not bad, but it's also not great, and it's not the sort of numbers that you get everybody excited about to go buy that stock, right? Like 5%, people are like, that's kind of sleepy. And you got to keep in mind, PayPal used to be a company that would grow kind of similar to like a Google, a Meta, and Amazon, companies like that, right? Well, the thing is, Google, Amazon, Meta, companies like that, you know how fast they're growing revenue? Double-digit clip. PayPal just grew revenue 5 whopping percent. Now, to make matters even worse, you would say PayPal's what? A fintech company. Well, what are some other fintech companies out there that are very, very popular? Well, I can tell you some. Coinbase, Robinhood, SoFi. Look at those companies' growth rates. And you'll see why no one wants to buy PayPal. because they're like, why would I want to buy PayPal with 5% revenue growth when I could go over to SoFi and get what? 40% plus revenue growth? Look at the Hood's growth rates. Look at Coinbase, those sorts of companies. So people are like, why do I want to own PayPal once again? Like 5% revenue growth and these other companies growing like this. And you got to understand, a lot of people are growth investors, growth traders, right? And so they look at a PayPal and like, put me to sleep, 5% revenue growth. And so this is helping kind of lead PayPal to just be a dead money stock, right? Now, additionally, if you look at PayPal and Venmo, they're having trouble really growing their user base. Active accounts grew from 429 million at the same time last year to 438 million. So they had about 9 million active accounts, which might seem like a pretty decent number. When you're on a base of 400 million plus active accounts, that's not much. It's only like roughly 2% growth year over year. I mean, that's just, a lot of people are going to look at that and like 2% growth. I mean, you got these other companies growing users, at double digit clips like it's nothing in the fintech space. And so PayPal growing 2%, people are like, that's almost stagnant, right? Now, to be fair to PayPal, right? Listen, PayPal is still innovating. This just came out yesterday. This is brand new news. PayPal, on the heels of PayPal World announcement, a global platform connecting the world's largest digital payment systems and wallets, PayPal today introduced PayPal Links, a new way to send and receive money through a personalized one-time payment link that can be shared in any conversation. So let's say, I don't know, you are somebody that details cars. Okay, you go to people's house, you detail their cars for them, right? Charge them whatever amount of money. Well, now with this, you could just send over this link. Maybe they contact you via Instagram, so you send over the link, through an Instagram DM. Maybe they text you to schedule the car detailing, so you could send it over that way, right? Real easy, real seamless. This, I gotta say, this is a type of thing that I feel like PayPal should have been doing 2-3 years ago, right? If not 4 years ago, but it's here now, okay? Finally here. PayPal users in the US can begin creating personalized payment links today, with international expansion to the UK, Italy, and other markets starting later this month. By making payments this simple and universal, PayPal Links helps drive new customer acquisition and brings more users into the PayPal ecosystem. The peer-to-peer, P2P experience is about to go even further. Crypto will soon be directly integrated into PayPal's new P2P payment flow in the app. This will make for a more convenient way for PayPal users in the US to send Bitcoin, Ethereum, even PayPal USD, and more, right? PayPal, as well as a rapidly growing number of digital wallets. So, great. It's great to see, right? But it's something you looked at and you're like, PayPal should have already done this 2, 3, 4 years ago, right? But the moral of the story is they got it done. It is good. They are still innovating, right? Alex Chris is pushing the company forward. The last CEO just really let him down because, like I said, this should have been something that was done under the last CEO's. Man, this is it's a great feature. Like, it's phenomenal, right? Like, I could see even me doing this back in the day when I had my real estate marketing company, right? Where I would do videos and photo shoots and things like that for folks, right? And all my customers would either contact me via email to book me for jobs or via text. It would have been great to just send them an easy link. Like, here's a link, boom, right from PayPal. It's just frustrating that it's taken this long. Like, I'm like, this is something that should have been done years ago, just to be quite frank, right? But it is a good feature and it will help PayPal adoption. Now, here's the deal, okay? When it comes to me looking at PayPal stock, and I say this stock has been dead money for me for nearly 2.5 years, do I go ahead and cut loose the rest of the shares? Do I buy more of the stock? Do I just hold this stock? Those sorts of things. I've got to look at things like the forward P. I got to look at things like, what is the expected earnings per share growth, right? And do I think that's accurate? What do I think is a future revenue growth? Well, if we look here, PayPal trades at a forward P of 13. Now, once again, that's always an estimate, but that should roughly be in line, right? We can say somewhere between 12 and 14. So 13. Next year, expected earnings per share growth is expected to be, let's call it, very nice double-digit growth of 14 to 15%, somewhere in there. Next year, revenue growth is 6.5%. Here's the deal when it comes to if I'm going to cut this one loose or not. Listen, I can't cut this stock loose. I can't do it. It's at a forward P of 13 with double-digit earnings per share growth and mid-single-digit revenue growth. I just can't cut that one loose. Like, it's just too attractively valued. And even though it's been dead money for me, I can't cash it. I can't cash out, man. It's just, at the end of the day, like the likely investment return for me over the next several years is too attractive. And so although it's annoying, and I'm like, I've held the stock for nearly 2.5 years and I've made hardly any money, it's annoying, but at the end of the day, like, I can't really cut a stock like this loose. Now, if the company's revenues were going down, that would be easy. I'd be able to say, you know what, the company's revenue is going down. This ship's, it's going down like the Titanic. It's time for me to get out. That'd be easy. But with, mid-single digit revenue growth, I can't really cut that loose, right? Now, additionally, when you look at this company, look at the operating income on a trailing 12-month basis. I mean, it's sky high. It's higher than it's ever been. So it's a company that can throw off operating income of $5 to $6 billion a year. The market cap of the whole company is a little over $60 billion. And they're throwing off $5 to $6 billion a year in operating income. Whew. Now, listen, with all that operating income stacked to the sky, you know what they can do? Massive share buybacks. When you do massive share buybacks, you end up skyrocketing your earnings per share because you're taking way more shares off the market, right? So, I mean, these are all things to factor in here that are very, very important to consider, right? Now, this is our earnings per share. We're looking at 1000xstocks.com, right? This is our earnings per share. This is where we're at right now on a trailing 12-month basis. This is where we're expected to go. And I have no reason to disbelieve this. When I look at what's going on with the operating income of this company, right? When I think about how many shares are going to be able to take off the market over the next few years, I have no doubts in my mind that earnings per share is going to skyrocket right up like that, if not even a little bit higher. So it's very difficult for me to cut a stock loose. It's likely going to have double-digit earnings per share growth per year for years to go in the future. That's trading at a forward P of 13. That's tough, man. That's really, really tough. So PayPal, one side of me wants to cut it loose because it's been dead money. The other side of me looks at the numbers, the math, and says, you can't cut that loose. Come on, man. What are we doing here? Okay.
Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you looking at in front of you right there? That's the 6-figure Hall of Fame. Do you want to see the next one? That's the 7-figure Hall of Fame. Now, that is my private group. Those are members of my private group that have scaled to 6 figures, multi-6 figures, 7 figures, multi-7 figures in their stock market portfolio. They say you are the average of the 5 people you associate with. If you're somebody that is having trouble finding other long-term investors that are focused on building their wealth over the coming years, finding like-minded folks, look no further than my private group. We got a tremendous amount of people. We're consistently talking with each other, learning from each other, researching companies together, sharing news about our different companies, right? We do all that inside my private group. If you would like to apply to join us in there, go down in the description area. There'll be an application down there. You can click on that and you can apply to join us in there and take your game up to a much higher level and associate with the type of folks that you actually want to associate with.
Day with the stock market at record highs, the 10-year yield back down to 4%, gold up 40%.
Before we get into this one, let me just state my opinion on the economy. I think the economy is just a very meh economy right now. I don't think the economy is great right now. I also don't think it's a disaster zone right now. I think it's very meh. And I think this economy could go either way in 26. I think we could either talk about a strengthening economy in 26. I think we could also talk about an economy that gets worse in 26. So that's kind of my view on the economy. So whenever somebody says, oh, the economy is so booming right now, I'm like, I don't think it's booming. Just based upon kind of what I look at for the overall economy, right? Once again, take us out of NVIDIA, Meta, those companies at the very strongest. I'm looking at a lot of mom and pop businesses, right? Small business. I'm looking at consumer sentiment. I'm looking at the real jobs picture, and it feels very meh. Not great, not a disaster, very meh. And so that's kind of my view on the overall economy right now, which the economy is not always the stock market, right?
How do you view the risk reward into the Fed?
I think what's really interesting is how the shift in focus from the market has been on inflation and what the Fed's going to do to now a weakening labor market and a slowing economy and what the Fed is going to do. The bond market is telling us the Fed is certainly going to cut. We've seen yields come in a lot in the last few weeks. And yet the equity market continues to hit new highs saying, we don't need to cut. Everything's running along smoothly. So it's a little bit confusing, the signals we're getting from the market. But I think the reason the equity market continues to run is because the expectation is the Fed is cutting not because we're in trouble or because we see a recession. So they're viewing that as a positive signal from that Fed.
Yeah.
But Neuberger Berman's expectation is right in line with the markets of a 25 basis point cut tomorrow.
Do you see the market continuing to rally? A lot of people see this as a buy the rumor, sell the news. There's a risk that he's not quite as dovish as the market is expecting.
Yeah, I mean, the market is strong. The economy is strong, driven by the consumer. We saw retail sales come in this morning 3 times higher than consensus. Now, August is a strong month. It's back to school. There's lots of spending, but that's a significant growth over consensus. And the earnings came in. Expectations were a little bit under 5%. They came in 12%. Companies are strong. Lowering rates is only going to strengthen them because the burden of the interest expense will be lower. And lastly, there's this CapEx spend that's been announced by the Mag 7. $500 billion expected over the next 2 years. We don't know, those companies don't know what the technology of the moment is going to be in 12 or 24 or 36 months, but they are committed to not falling behind. So I think that CapEx spend is a little bit of a stimulus in the market, certainly for tech stocks in the Mag 7, which we've seen come up 50% since the lows in April. So the economy seems strong. The market is certainly strong, but we are seeing signs of slowing, not concerning. We're seeing signs of a weakening labor market, which is really what I think the Fed is telling us. The most recent JOLTS numbers suggest that there are more people looking for jobs than there are jobs available. The labor market's weakening on supply and demand side. I mean, companies are not firing, but they're not hiring. Our jobs added is significantly lower than it was 12 months ago. So when you look at the unemployment number, 4.6%, in terms of a historical context, that's still a very low number. But if it's on the rise, that's something that the Fed needs to focus on.
IWM is definitely beating the S&P for the quarter to date. Would you stick with that, assuming we get at least a rate cut tomorrow?
I think we're going to get a rate cut tomorrow. And yeah, I think, look, we believe in broad-based diversification within your portfolio, but the S&P is driven right now and has been for 2.5 years by this bundle of 7 securities, and we just don't see that falling away. So we're mindful of the valuations. We're mindful of the unintended consequence that a 70% cumulative market has given us over the last 2.5 years. It's great because the market's up 70%, but client portfolios, as we've discussed before, have unintended risk through overexposure. So there's also some uncertainties that we don't know about. We've been talking about the trade talks with China. Secretary Bessent was on this morning talking about that. There's a lot of geopolitical risks. Tariffs are at 10%, but once these pauses end, they're going to go up to around 18%. Now, no one knows when the pause is going to end.
Or if they're legal.
I mean, just a few tidbits to sort out here. Right. But there are some uncertainties. So we think the market's going to continue to rise, but we are cognizant of the risks. So we are neutral in our allocation, an overweight to small caps, which we've been talking about, which is disappointed up until August. But in August, the Russell 2000 beat the S&P by 3 times for the month.
I think you could make a much stronger argument that the economy is actually weak rather than strong. You know my feeling, I feel like we're in a May economy. I feel like it's not necessarily weak, I feel like it's not strong. I feel like it's meh. But I think if I had to make a case about the economy strong or weak, I think I can make a way more compelling case that the economy in 2025 is weak. Very weak. I could make a much stronger case as far. I mean, you could even look at, you want us to know another company? I'll tell you another company that sales have literally been in free fall, right? You know what company that is? And they're supposed to be growing like insane. You know what company that is? Tesla, my Tesla. Look no different than Tesla. Like, if we're in a super strong economy, why has Tesla sales been so trash the past year? I think it's a fair question. Now, so you might say, well, Elon, and everything he's posted over the past couple of years on X, and, that's made his customer base extremely mad, and so no one's buying Teslas anymore. Like, you can make that argument, right? But the moral of the story is, like, you look at all the price cuts they've done, And they were supposed to have this insane growth. Elon Musk used to talk about, oh, we're going to grow 50% a year, right? And their sales are literally going down. If it was a super strong economy or a strong economy, right, should Tesla sales be going down? Shouldn't they be going up significantly, right? So these are all fair questions, right? So once again, I think you can make a stronger argument that the economy is weak rather than strong, but I feel like it's meh.